All right. Good morning, everybody. And happy Inflation Day. Uh-oh, I got the music on a loop. Happy Inflation Day, everybody. Today is September 13th, 2023. Happy birthday, Mini-Me. And guess what? Today is CPI. In just 4 minutes, we will get the Consumer Price Index for August. Market expectations are, let me know in the comments what your expectations are. But right now, the market is expecting a 3.6% year-over-year headline inflation number and a 0.6% month-over-month headline number. That would be up from last month's 3.2% year-over-year headline. Now, that's being driven largely by increases in energy that we saw last month, but also a little bit of the base effect. About a year ago, inflation leveled off just a little bit before starting to head lower. Core inflation, we're looking at an expectation of 4.3% year over year and 0.2% month over month. So generally, we're into this good news is bad news is good news kind of scenario here. So if we get an inflation number that is higher than expected, we're probably looking at the market taking a bit of a nosedive here, because that would mean a more aggressive Federal Reserve, possibilities of more future rate hikes. So that would send the market a little bit lower. If we get a lower than expected CPI number, the market will probably like that, meaning that, hey, the Fed might not crank the screws to us, just maybe not quite as hard as they were going to. So the pivot talk would take over and the market would move higher on that one. Now, I just want to take a look here. Let's shrink my big melon of a head. And while we're shrinking my melon of a head, why don't you please inflate that like button, everybody? It really does help me for the YouTube algorithm. And, of course, subscribe to the channel. If you're new here, we do this every morning, and every month we do the CPI live, and I'd love to see you guys next time. So what we're looking at here, this is bls.gov/CPI. This is the website where Consumer Price Index will be released. And down here in the lower right, that's where you're going to see it. It's still showing the July number right now. There's that 0.2% month-over-month headline number from last month. And here is, just to give you a quick rundown, this is a chart of the headline year-over-year number going back all the way to about 2003. You can see CPI has kind of bounced around. It went negative for a little while after the GFC, but pretty much been in this 1% to 2% range for quite a while until that big spike that we saw in 2022. It peaked in June of 22 at about 9.1%, and we've been falling pretty substantially ever since, although we have seen an ever so slight uptick in the last month or so, the most recent reading being 3.2. Some of the big contributors that we saw last month, I just want to run down some of the numbers from the last one. We had energy was a big negative last month at negative 12.5. I expect that's going to probably be either a smaller negative or even a positive number this time around. We've seen an increase in our energy prices. New vehicles at just 3.5%. That's way down from where it was. And used cars and trucks was negative 5.6% year over year. That's a pretty deeply negative one. I'm expecting another negative number for that. Whether it got worse or a little bit better, I still don't know. I haven't been following the auto market quite that closely. Another big one is the shelter index, which was 7.7%. That includes that all-important owner's equivalent rent number. And, of course, the transportation services index at 9%. That's the one Jerome Powell is watching. That's his core non-housing services. He wants to see that one come down before he declares victory over inflation. And that one is still sitting high at 9%. So we are now at 8:30. Let's start refreshing the page, because I think we're about there. Hold on. Here we go. Let's refresh. Do we have the new one out yet? There we go. We've got 0.6 for August, month over month. That is in line with the month over month. What's the headline number? 3.7%. So it's a little bit higher than expected. The market was expecting 3.6. So we've got 3.7% year over year headline inflation. I'm going to read off the report here a little bit. The Consumer Price Index for all urban consumers, or CPIU, rose 0.6% in August on a seasonally adjusted basis. That's after increasing 0.2% in July. That's according to the USBLS. Over the last 12 months, the all items index increased 3.7% before seasonal adjustment. The index for gasoline was the largest contributor to the monthly all items increase. We talked about that. That's accounting for over half of the increase. Also contributing to the August monthly increase was continued advancement in the shelter index. That's interesting. So they're still showing rent getting more expensive. That rose for the 40th consecutive month. That's quite a streak you've got going there. The energy index rose 5.6% in August as all the major energy component indexes increased. The food index increased 0.2% in August as it did in July. That's a more modest increase, but it still bites people. The index for food at home increased 0.2% over the month, while the index for food away from home rose 0.3% in August. The index for all items less food and energy, this is your core number, that rose 0.3% month over month. That is higher than the market was expecting. Market was expecting 0.2%, and that's following the 0.2% increase in July. Indexes which increased in August include rent, owner's equivalent rent, motor vehicle insurance, medical care, personal care. The indexes for lodging away from home, used cars and trucks, and recreation were among those that decreased. So this looks like hotter than expected, guys. Not by much, but this is definitely a higher than expected inflation reading. It's only by about 1/10 of a point, but we'll see if that's enough. If you were hoping for a low CPI print and the Fed pivot talk to take over the narrative, you definitely didn't get what you wanted. But I don't know that this was necessarily going to be this bludgeoning over the head that some were afraid of. Here's your headline number. We've got 3.7% year over year headline. And then there's your 0.6% month over month number. Looking at the food index, we've got 4.3%. That is up from 4.9% last month. So food is getting worse. Food at home still at 0.2% month over month. The energy index of negative 3.6. That's a big jump right there. Now it's still negative. Energy is still lower than it was a year ago. But last month that was negative 12.5. So a big increase in the index for energy. And you can see it right here. Look at that month over month number, 5.6% month over month increase in the overall index for energy. That is a tough one right there, guys. And it's pretty well spread out. Look at this, gasoline, 10.5% in a month. What else we've got? Fuel oil, 9.1%. Energy commodities, 10.5%. What else we got? Energy services still negative on the year over year front, but a little bit in the positive territory here for 0.2% higher for the month. Electricity was higher for the month. Utility piped gas service was just barely positive for the month, but still down pretty substantially year over year. But energy, big contributor to this month's inflation reading, especially that index for gasoline at 10.5%. That's a big one. What else do we have? All items less food and energy, i.e. core inflation, that came in at 4.3% year over year. That is in line with expectations, but the month over month number of 0.3%, that's a little bit hotter than expected. I don't think I'm going to read too much into that. That month over month number may spook a couple of people, but I don't think it's going to make a huge difference. Let's see what we got. New vehicles was 2.9%. Now that's that's down from 3.5%. So that's probably the result of your higher interest rates, and the higher payments is pricing a lot of people out of the new vehicle market. So we did see a little bit of a month over month increase of 0.3%. That's a little bit of an outlier considering these most recent months where we had negative 0.1, we had flat, negative 0.1, now a jump of 0.3. So the year over year numbers coming down, but that 0.3% month over month, that could be a little worrying for new vehicles. Used vehicles continues to be a drag on the overall index. That's down 6.6% year over year. That is lower than the negative 5.6 that we had last month. We've also gotten negative 1.2 in the month over month number. So the price of used vehicles continues to fall. What do we got here? We've also got apparel, 3.1% year over year. That's not too alarming there. The index for shelter of 7.3%, that is down from the 7.4% in the prior month. And we've also got the month over month numbers a little bit lower for shelter. We had 0.4%, now 0.3%. So we're seeing a continued deceleration in the cost of the rent, in the price of owner's equivalent rent. The price is still going up in the index, but it's going up slower. We've got disinflation in shelter. That's a big one because that counts for over 1/3 of the index. And lastly, this is not good here. The transportation number. All right, this one is a little worrying, guys, because this was 9.0% year over year last month. Now it's 10.3%. Now, remember, transportation, that is the most important component in that core non-housing services that Jerome Powell keeps talking about. This is the number Powell wants to see come down before he declares victory on inflation, and he didn't get it this month. It's still going in the wrong direction. So now the month-over-month number of 2%, that any way you look at it, guys, that's terrible. That transportation number is terrible. Powell's not going to like it. I would keep an eye on that one. He'll probably mention that in his next press conference, which is in just a couple of days here. So let's see how the market is reacting to this right now. First of all, we got the fear greed index is currently sitting at 51 on the fear greed index, just in neutral territory, leaning a little bit to the greed side. All right, looking over at the futures right now in the S&P 500, it looks like we took a little bit of a dip lower on that initial release, and now it's bounced back up, essentially unchanged. So the S&P is down 0.3. It's flat, no change in the stock market. So stock market is shrugging this one off. The Dow is actually a little bit in positive territory pre-market right now. Again, we had a little bit of a dip, a red candle down, bounced right back up. The algorithms aren't really sure what they want to make out of this, is what this one is telling me right now. And the NASDAQ it's in negative territory, but just barely a fraction of a point. It's probably going to be positive by the time I'm done with this breath. Again, big red candle down, popped right back up, and there we go, positive territory now. So stocks aren't really reacting very much to this news. I'm a little surprised because this is worse news than I think the market was hoping for. Now, I wouldn't expect the market to absolutely puke lower on this one because a lot of this was driven by energy, and the Fed isn't really worried about energy. But the core number was a little hotter than expected, and that transportation services number, that's worrying. I think that's probably the one that Powell is not going to like, and I would expect the market to have reacted a little bit more strongly to this one. I'm not expecting a 1,000-point down day on this news or anything like that. But still, I think the market is pretty much shrugging this one off, at least in the first couple of minutes here. We've got the U.S. dollar is about 5 basis points higher and heading lower at the moment. Surprising, currently 104.76 on the DXY. Again, not much of a reaction here. We've got interest rates in the bond market a little bit higher this morning. 30-year Treasury yielding 4.38%. That's up almost 5 basis points. The 10-year is at 4.31. That's up about 5 basis points or 1.23%. And the 2-year is yielding 5.03. That's up another 3 basis points. And lastly, we've got the 1 month still sitting pretty much where it's anchored, 5.386, unchanged on the day. So not a lot of reaction in the bond market. Over in commodities, we got gold is heading lower on this news, down $1.45. That's for December gold futures trading at $19.33. December silver futures at $23.16. That's down about a quarter this morning, or a full 1%. And West Texas Intermediate crude still heading higher. Look at that oil, $89.13 for October WTI futures. That's up another 28 cents this morning, or about a third of 1%. The march higher in oil continues. And platinum and palladium are pretty much unchanged. We got October platinum futures are down about $8 this morning, and December palladium futures are higher by about 4 3/4. So, guys, not a lot of reaction in the market to this news. I'm a little surprised to see it, to be honest with you. I would have expected a stronger reaction here, especially considering that transportation services number and that all items less food and energy. This number coming in at 0.3% month over month. It's just a little bit hotter than the market wanted, but still I would expect a reaction. Maybe the market is chalking this all up. They're saying, oh, it's just gas prices. It's just the Saudis. It doesn't have anything to do with monetary policy here in the States, and so never mind. But I think when they dig a little closer into this numbers, especially this one here, man, when they see that transportation number, I think when they look closer, they're going to say, oh, that's the one the Fed really wants to see come down, and it's not coming down. Now, we've also got indexes for medical care. We're down a little bit lower. That might be partially offsetting a little bit of the core non-housing services. But that one right there, that up 10.3. Not only is it not coming down, it's still getting worse. It's going in the wrong direction. So we really need to see that one come down before Powell declares victory. Also, guys, forget the Fed for a minute. These energy numbers, I mean, gasoline rising by 10.6% in a month. That's people's lives. That is people's budgets being hit. So, when people need to balance the checkbook at the end of the month, when the in needs to match the out, or they need to dip into savings, or they need to go into debt. It doesn't matter where the inflation came from. The fact is life got more expensive for them. So even though Powell may not be so worried about what the gasoline market is, the average consumer is. And if they're spending more on gasoline, that's less left over to spend on apparel. That's less left over to spend on a vacation. That's less left to spend anywhere. And keep in mind, guys, we've got those student loan payments. They're coming back. Just a couple more weeks, student loan payments will be back. $400 a month for about 40 million Americans. That's going to take a big chunk out of people's monthly budgets. So if you're just joining us, guys, the headline inflation number was 3.7% year over year, 0.6% month over month. And the core inflation number, 4.3% year over year, 0.3% month over month. That is hotter than expected, but just barely, just by a tick. So nothing too alarming. Markets still not reacting. S&P's a little bit lower by 5 points. Dow's lower by about 23. NASDAQ's lower by 26. So, yeah, the market's moving lower now, but not in a big way. A pretty muted reaction. Now, let's talk about a couple of other things that I see going on in the market today, because we're not going to do our regularly scheduled live stream at 9 a.m., not with CPI coming out so close. So we're just going to roll right into some of the other stories of the day. We did see this one came out yesterday. This is the Johnson Redbook Index. And this is one of my favorite data points, especially because this doesn't get much attention in the mainstream press. But first of all, it's a weekly data point. You get it all, every few days. So you get more granularity versus waiting for a monthly number once a month. This is a measure of same-store sales in retail. And this measures a huge sample size, a huge population of retailers. And this is measuring the weekly sales versus the same week a year ago. And this is a year-over-year change. And the Redbook Index has been trending positive for about 7 weeks now. We had 3 consecutive weeks of negative numbers back in July. Now, these are not adjusted for inflation. So when we saw these negative numbers, you can subtract inflation from that even. So these were a lot less stuff was selling in early July. But you'll notice that trend has reversed, especially in August. We took a big step change up towards the end of August, and we're continuing higher. So retail sales for the last 7 weeks or so, they've been juiced a little bit. I mean, they've been coming out pretty good. 4.6% year over year increase in the Johnson Redbook Index. And that is versus a year ago. And keep in mind, we just got the inflation number of 3.7% year over year. So retail sales are rising faster than the rate of inflation. That means more stuff is selling. So taken in a vacuum, that's a very good data point. That tells me people are spending more money, that the consumer is strong. However, with an asterisk, you've got to keep in mind this chart, guys. And this is America's credit card bill, consumer loans, credit cards, and other revolving plans for all commercial banks. I'm going to zoom in on this one to just the last couple of years since the pandemic. And you can see this thing just continues to rise, guys. Over $1 trillion in credit card debt for Americans right now. $1.012 trillion to be exact. And it's still rising. So when I see those Johnson Redbook numbers looking good, it's not necessarily a good thing, because that's not coming from higher wages. That's not coming from prosperity. That's people going into debt to try to maintain the same standard of living as a year ago. That's not sustainable. This is all spending at the expense of tomorrow's spending, because when the banks cut off those credit cards, and they are going to cut off those credit cards, we're seeing rejections are on the rise. We're seeing banks tightening lending standards. We're seeing applications for credit limit increases getting rejected at an increased rate. So the banks are not going to be willing to lend much longer. So we should see the trend of this growth start to level off as the banks say, we're starting to worry that you can't pay us back, and so we're not going to increase your limit. And then what do people do? When people are already on maxed out credit cards, they can't get another one, and the cost of living is more than their wages. That's when things get a little hairy in the economy right now, and it looks like we're already in the early innings of that one. Now, I got a couple of other things I wanted to talk about, because speaking of that transportation services number, now that was interesting. Again, I talked about it because that's a very important one for the Fed to watch. But my moderator, Mish, pointed this one out to me, and this is pretty interesting today. American Airlines, Spirit Airlines cut summer profit forecasts on higher costs. So this is that higher energy index in the CPI starting to bite into the airlines. And we've had a lot of airlines in just the last couple of days have warned about this. They're starting to lower their estimates for their earnings. Higher fuel and other costs are biting airline profits in the third quarter. American and Spirit joined Alaska and Southwest in cutting profit estimates for the summer. American Airlines and Spirit Airlines on Wednesday joined other carriers in warning that higher costs will hit profits during the bustling summer quarter. American said it expects adjusted earnings per share to come in between 20 cents and 30 cents in the third quarter. That's down from a previous forecast of as much as 95 cents. This is not just a little adjustment lower in their earnings, guys. They're cutting them by by over 2/3. They're saying 20 to 30 cents instead of as high as 95. Right, so not a minor adjustment. The airlines are in trouble here, and they're citing more expensive fuel and a new pilot labor deal. Remember that one. There's your wage spiral inflation that Jerome Powell is worried about, that Keynesian boogeyman that lurks in every closet, under every bed, and behind every shadow. Well, the airline pilots, they were threatening to go on strike. They got a sweet deal. What was it, a 40% raise for the airline pilots? The UAW, that's the United Auto Workers Union, they're asking for a similar raise. We saw the big raise for the UPS drivers recently and for the package handlers at their facilities. So these labor disputes are driving up wages, and that is cutting into the profit margins of a lot of these companies. Will it result in higher prices? I don't know. It's already resulting in slimmer margins, but I think we're finding here that the airlines don't have the pricing power that they did a year ago, and so they're not able to raise those prices, and instead it's cutting into their earnings. Watch out, all you guys who are holding shares in airline stocks right now. The carrier halved its operating margin from a forecast earlier this month to 4% to 5%, so the margins are getting cut. Spirit Airlines expects negative margins of as much as 15.5% in the 3 months ending September 30th, down from an earlier estimate of 5.5 to 7.5. So I guess it's going to cost you another $5 if you want to carry a bag onto your Spirit flight. The budget airline also cut its revenue forecast for the third quarter. And this right here, this paragraph is pretty telling. Airlines have lost pricing power that they commanded last summer when capacity was more constrained coming out of the pandemic, even though demand has been strong. So that transportation services inflation that we saw, again, that was a pretty shocking number. What was it? 10.3% in the transportation services year over year inflation. It looks like it's probably not going to last because all of these airlines are starting to cut their profit forecast. They're saying the higher fuel costs, they're cutting into our profits, and we can't raise prices. People won't pay them. So we should see that transportation services inflation start to come down any day now. Another story that caught your attention, something you want to keep an eye on, especially you crypto guys, watch out. Binance US CEO has left, and the crypto exchange cuts 1/3 of its workforce. Guys, I have to tell you, I've said this over and over again, get your coins off the exchanges. Do not wait, run, do not walk for the exits. Get your coins off the exchanges. The SEC is going after the exchanges. Almost every exchange, even the good ones, are having some kind of problem right now because of this SEC crackdown. The only safe place to store your crypto is in your own custody, in your own cold storage wallet. I can't pound the table enough on this one. There's going to be people that lose everything. People are going to ignore all the warnings, just like they did with FTX. When Binance goes down, a lot of people are going to get wiped out, and Binance is going down. The writing is on the wall here. The company says its actions give it 7 years of financial runway, not a chance. Binance.US CEO Brian Schroeder has left the crypto exchange, and the company has eliminated 1/3 of its workforce, according to a spokesperson. It's been a tough year for crypto exchanges in the U.S., with Binance.US feeling particular pressure. The SEC sued the company in June for allegedly violating securities laws, which built on accusations from another American regulator. Guys, if you still have money on Binance at this point, there's probably nothing I can do to help you. This guy, Changpeng Zhou, the CEO of Binance, he just makes my skin crawl. He's worse than Sam Bankman-Fried. He's essentially just SBF without the stupid hair. You've been warned. That's all I can say. Something else I thought was interesting. We've got the governor of Georgia has announced that he's suspending the gas tax. Georgia gas tax suspended by Governor Kemp due to inflation. Georgians will get a break from paying the fuel tax at the pump now that Governor Kemp has declared an inflation state of emergency. In a move aimed at alleviating financial strain caused by inflation, Georgia's Governor Brian Kemp declared a state of emergency and temporarily suspended Georgia's gas tax. This means Georgians should see some relief from the state's excise tax on motor fuel. This is going to be somewhere around 30 to 35 cents a gallon. in tax relief when you pay at the pump. But I have an idea here, guys, because every time gas prices go down, every time there's a big dip in gas prices, these a-holes in the state legislatures and in Congress pass a new gas tax. Every time life gets a little cheaper, our elected officials say, no, we might as well help ourselves to that money. People won't even notice it because they used to pay it anyway. And they raise gas taxes. They tell you we're going to use it to fund our schools. They tell you we're going to use it to fix our roads and our bridges, but they never do, not ever. They just raise the tax and take more money from you. But then when the fuel prices go back up, they just temporarily suspend the tax, if they even do anything at all. How about you actually legislate and lower it? What a concept. Let people keep more of their own money. I know, don't throw tomatoes. I just throw the ideas out there. You do what you want with them, all right? But what a concept. Maybe we just lower the taxes. Maybe governments get less involved in our life. What a concept. Let's take a look at CME futures this morning and see if they're reacting at all to this news of CPI. Looks like the odds of a September rate hike are currently just 5%. That's down from about 7% a few hours ago. So it looks like this inflation reading, it probably was the final nail in the coffin for that September rate hike, but nobody was expecting that anyway. Only a 5% chance right now. It's not happening. They're not going to raise rates in September, but you know what? They've already skipped a month. They did that a few months ago. So nobody was really expecting that, but the November rate hike, that's the big one. And right now, the odds of a November rate hike are sitting at about 42%. That's 39.8 for a 25 basis point hike and 1.9% for a 50 basis point hike. That's down by about 1% total from this morning. So interestingly enough, even though inflation was a little bit hotter than expected, the market is at, the market is actually saying a slightly less likelihood of a November rate hike now, despite a slightly higher than expected inflation reading. That's an interesting reaction. We'll see if that one holds. Going back right now, again, the market is really not knowing what it wants to do with this number. S&P is a little bit higher by 2 points this morning. The Dow's now higher by 20 points ahead of the open, or 16 points ahead of the open. NASDAQ's still in negative territory. So not a lot of reaction, guys. This was very much a meh inflation report. Again, 3.7% is the headline number. Not really a game changer. I guess that's the takeaway here. It really just didn't make all that big of a difference one way or another. And guys, I think we are going to call it there because it's been pretty much a nothing burger kind of inflation report here. And, I'd love to sit here and nitpick on the details, but I'm not going to waste your time. So lesson learned, guys. Inflation a little hotter than expected. It was mostly due to energy. Keep your eye on that transportation services number. I bet you we hear from Jerome Powell about that one during his next speech. Also, guys, if you're new to the channel, please won't you hit that like button and subscribe while you're here. I also want to say thank you so much to my Patreon supporters for everything you guys do for the channel. Looking forward to talking to you at 5 p.m. Eastern time today for our weekly Zoom call, where I'm sure we're going to talk more about this inflation report. Also, I got to say hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.